Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us for this week, the last week here before Thanksgiving, which is kind of crazy to think about, and but not for Andrew. If you look at him, he's looking beyond that, there with the nice Christmas tree behind him. So I applaud him. He's always full of Christmas spirit, and you got to have those in the office. So, Andrew, thank you for carrying the ball for the asset management team. This week, we've got a few topics. We're going to talk about long-term asset returns. And when I say long-term, I mean really long-term, maybe some fresh perspective in a couple of lights. And then we're going to talk about debt, both on the government side and the consumer side, and putting a little context around that, which I think is helpful. But turning to the long-term asset return. So there's an interesting study put out here showing very long-term cycles, in fact, broken down into 25-year time frame. So looking at a whole quarter of a century. And this one is unique. We're showing up the December 31st, 1999 and through the present time. So almost to the end of this quarter of century. But gold is actually in a rare time frame over that time frame, actually exceeding S&P 500 returns. Meanwhile, treasury bills and bonds just a little bit onto the positive side, but unique in this era of gold actually outperforming. The next chart, the next slide here, we'll break it down into a little bit more context here, showing you by asset class, by quarter century. You can see how rare it is and how important equities are. I think most of you watching that understand that, but here's just another version of it to show you how important equities are, because they are one of the few, or really the only asset class that consistently generates 5% or greater real returns. Real returns meaning that above inflation. So I think that's important. You will see periodically things like gold, periodically getting into that category, but equities are the one that really generate that over that time frame. So it'd be unlikely, in other words, to see another run like gold. However, what's important for us is the years ahead. You know, we're not really looking at where 25 years from now will be. So if you look at your portfolios, you will still see some gold in there. The last thing that I'll point out is the home price appreciation. This quarter of a century, which included the housing boom, the housing bust, and then, of course, the COVID boom that saw house prices go up. And we have seen a real price appreciation for homes, which historically is unique. House prices have historically basically just kept up with inflation, not shown real meaningful real price growth. So the 2.3% real returns in homes, historically, we would say has a tough time of repeating that going forward. Just something I think important to keep in mind, especially for young people making long-term decisions in their assets. So that's an asset side of the ledger. I'll turn it over to Andrew to really tackle the debt.
All right, thank you, Adam. So we're going to look at debt from two different angles, both of which are very important, but we're going to start with the one that looks for the government debt. A hot topic, it seems to be every year, especially as we come out of a political cycle, is looking at government spending, something that I think we can all probably agree, maybe the government spends just a little too much money. But I think this is a topic that often gets confusing, and we can start seeing when really big numbers, we start talking about trillions of dollars. It can sound like a lot, and it very much is, but we need to put this in context. And we think that a lot of news stories very much look at this probably from the wrong angle. So we want to clear some things up, as we do get many questions on government debt and spending from our families. And so the first chart I want to show is looking at government spending, but looking at it in the context of the overall GDP, so gross domestic product. As our economy grows, thankfully, we also typically will see government spending increase along with it. And so this chart goes back quite a ways back. This goes back to ultimately 1947 and looks at how much the government spends actually as a percent of our GDP. And as you can see, it has steadily been going up, but it's not to gangbuster type levels, or we're not seeing it go parabolic over the last 10, 20 years. It's really, if we look back during the 70s, it was just under 25%, which is about where we are right now. We did see it scale down during the early 2000s, getting right around just under in the teens, to under 20%, and it's gone back up. We see that big spike during COVID when the government had the big stimulus plans, and and all the things that was taking place during that time period. And then it's come obviously right back down and we're back to under 25%. And so while it's continuing to increase, we're not seeing it really accelerate as relative to GDP. We would expect that as the economy grows, that we're likely going to see government spending hopefully not be growing a lot more. And it has been increasing, but we're still, again, not to major levels or really seeing it exacerbate in recent years. Now we're going to look at the one that I think actually is more important and more impactful to you, more impactful for the economy, and what's most important to us, more impactful for the financial markets, and that's looking at consumer debt. Again, a very still another high number. We're still looking at trillions of dollars, but we want to, again, look at it from the right lens. And the way we can do that is looking at how much debt there is versus income. If your income is going up, if wages are rising, and then also we're probably going to see debt and go up as well. But actually, consumers have done a pretty good job of managing their own personal finances to a degree by looking at the debt to income ratio over the long term. So we can see the blue line, that's the debt. That's the one that's going up into the trillions of dollars. We have a lot of debt for consumers. The red line is what I want to focus on today, though. The red line is looking again at how much debt we have to income. And you can see that's been steadily declining. In fact, we're near some of the lowest levels in over a decade for how much debt to income we have as Americans. And that's a very healthy sign. That tells us that while income has been rising and debt is both going up, they're able to manage that fairly well. And then we obviously look at this and we go a lot more granular in our allocation meetings and allocation team, looking at different areas of debt, auto debt, student loan debt, credit card debt, all those different things. But what we wanted to bring for the market, Carver, is really showing that, yes, we are seeing debt levels go up, but when we have to look at them from the right lens, from either an income perspective or a GDP perspective, to really understand, are those numbers too high? And more importantly, what is the direction that they're going in? And for the consumer, which again is what's really driving that economic growth, the debt ratio there is continuing to stay pretty low, and that's encouraging to us.
Very well put, Andrew. Thank you. And thank you to all of you for giving us your time. As a reminder, next week is Thanksgiving, so we will return to your email box here in 2 weeks' time. So I hope you have a great time.
And then Christmas.
And then Christmas time. And then we will rejoin you here again in 2 weeks. Hope you have a wonderful time with your family and friends. And as always, we'll leave you with a reminder. If we can be of service, please give us a call, 800-928-4001. Thanks again and have a great weekend.